Joining us now to talk a little bit more and do a deeper dive on the Tesla story, Accipiter Capital Management General Partner Gabe Hoffman. Gabe, great to see you.
Glad to be with you.
No secret that you're short Tesla. You tweeted yesterday, quote, "If you think Tesla is taking a hit now, just wait until all the schmucks who bought a ton of calls the last 2 days dump them tomorrow morning." Your thoughts?
Well, that tweet did age pretty well. The stock was trading at 308 in the aftermarket, and of course, it's gone a lot lower since. Tesla's got major problems, and there was just some new breaking news from Inside EVs. Now, Inside EVs is an industry publication that is pro-electric car, and so they're not a tool of the shorts by any means. One thing that they do is they estimate monthly sales for all electric vehicles. Tesla delivered over 60,000 Model 3s in the fourth quarter and about 25,000 in the month of December. Inside EVs just came out and they estimated that Tesla delivered less than 6,000 Model 3s in the month of February. They estimated 6,500 in the month of January, and they estimated only 800 and 1,100 respectively of the S and the X. In other words, Tesla demand truly did fall off a cliff in the United States post January 1st, when we saw the $3,750 per car incentive from the U.S. government go away.
Okay, so let me get this straight. You're basically saying that the analysts out there and the rest of the investors in the stock as well, they may be wrong here in terms of their estimations on units, and that could materially impact this stock price.
Absolutely, and I believe that they're also incorrect in terms of the margin. Tesla slashed the price yet again on the S, the X, and the Model 3. But the S and the X by $6,000 to $10,000. Cars are not like iPhones. You don't just see big changes in the cost. It is largely a fixed cost and volume business. I believe that Tesla has a severe inventory problem. There are pictures all over the United States, literally hundreds of cars here, hundreds of cars there. They total in the many thousands, and they're simply not made up. Remember, Tesla was supposed to be a company where each car was supposed to be individually manufactured for what each customer pre-ordered. In other words, no inventory. And instead, Tesla looks like any old clunky car company with a severe inventory problem they're trying to liquidate, and those price reductions go almost entirely directly to the bottom line.
And Gabe, let's take this one step further. Elon Musk also saying that there's not going to be a profit in the first quarter.
That's right. And Elon Musk did that on a conference call last night with only select members of the press. He discussed other material financial information with only those select members of the press. So that's material information not disclosed to the public. Public still can't get hold of any transcript, any audio recording. I believe that is an additional plain violation of the SEC's Reg FD. Elon is obviously already in a lot of trouble with the SEC, and in my view, he just doesn't care.
All right, Wedbush saying that actually this all comes, it's the right move at the right time is what the analyst said, and that it's a game changer. So trying to look at this with the glass half full. Your thoughts on that call?
Well, Wedbush simply has mismodeled the company. You can't take $6,000 to $10,000 price reductions in the Model S and the Model X. You simply can't take the units that they have and just assume that costs go away. These analysts who cover Tesla at these smaller firms who are positive on Tesla, generally speaking, like this Wedbush analyst, don't cover other auto companies like GM or Ford or Fiat Chrysler. They cover other tech and other solar companies, so they don't really understand how the financials of a car company work.
Gabe, you know, Tesla promised that the Model 3 price would come down to that $35,000 mark, and it was getting criticized for not being able to fulfill its promise to the market and also to the buyers out there. Did you think closing dealerships were how they were going to manage their budgetary issues to get the price to come down? I mean, everybody expected the cost of the car just to come down, the cost to make it.
Well, getting rid of the dealerships, in my view, is just a last-ditch kind of desperation move on Tesla to try to cut any costs anywhere as much as they can. It doesn't come anywhere close to offsetting the price reductions that Tesla has had to implement to get rid of its inventory. But let's be clear, to buy a $35,000 Model 3, it's a pretty lousy car that I don't think anyone will want. For example,
right, because that has no options.
Right. So the mileage is extremely limited, 220 miles under ideal conditions, which means that if it's cold, that's about 120 miles. Number two, the seats are cloth, not leather, and you have manual seat adjustment and manual steering wheel adjustment. It's literally like a Yugo that you're getting for $35,000, and it ranks
I wouldn't say that.
27 of 29 in Consumer Reports.
All right, Gabe Hoffman, thank you so much. Great to talk to you today with your views on Tesla. Second ticker today is Gap. The stock is soaring after the company announced that it'll split into two independent, publicly traded entities. One comprised of the Old Navy brand, and the other is going to include the different brands that it has, like Banana Republic. It also has Intermix and Athleta. The news, of course, overshadowing Gap's mixed fourth quarter earnings results. Gap's board says that Old Navy's customers are, quote, increasingly diverged from its specialty brands. So different businesses require different strategies at this point in time. Yahoo Finance's Shauna Smith is here with me. Shauna, Gap actually expects the new company with the remaining brands to have about $9 billion in annual sales this year. Old Navy brings in about $8 billion on its own. So is this split really a smart decision?
It definitely is a smart decision, and that's being echoed from the street. You can see that in the stock's reaction today. A lot of that is because analysts are saying that these companies will now actually be fairly valued. You talk about the strength in Old Navy. Old Navy is a brand that has been outperforming for years. In 2018 alone, same-store sales increased 3% there for Old Navy. To put this in perspective with the performance of some of others Gap brands, Gap same-store sales fell 5% during that period. So this is a brand, Gap in particular, that has been suffering from the death of some of the malls, with mall traffic declining. They've been struggling with some operational issues, so they needed to make some changes, and this is exactly what Wall Street has been waiting to hear.
All right. In fact, you mentioned the fact that Gap, that foot traffic in the malls deteriorating. Gap actually closing 230 stores to focus on this restructuring. So does that seem like it's being hailed as a smart move by investors?
Yeah, I think so. And that's just because where Gap stands right now, they have so many stores. Taking just a look at the numbers, last quarter, they had 1,242 total stores. 758 of those are in North America. So their CEO, Art Peck, was just saying that those numbers, he said this back in November, the number of stores of what Gap has right now is just unprofitable. Changes needed to be made. They need to cut costs. And so they're estimating that by closing 230 Gap stores over the next 2 years, it's going to save the company between $250 and $300 million. So that, of course, is good news for a lot of shareholders.
And it's interesting, too, because when it comes to Gap and all the promotions that they run, a lot of these promotions come online. That's driving the online sales. So you really do have to question if they need that presence in terms of the brick and mortar stores. But another point that I wanted to make here is that Old Navy is competing in a different class now, right? With Ross stores, with TJ Maxx, with these lower end stores. And it seems like this split is taking the brands and saying, we're going to put a little bit of our more luxurious, our higher end over here, and we're going to manage the lower end business over here.
Yeah, but I think that is a smart move, because that is what Old Navy's brand is. They are going after those shoppers that are more conscious just about how much they're paying, the more discount shoppers. And those are actually a lot of the retailers that have been bucking the downward trend in retail over the last several years. We heard from Nordstrom last night, and an area of strength in their earnings report was their Nordstrom Rack, which is their discount line. So I think that by Old Navy, by being a standalone business, you mentioned how much money it generated last year, $8 billion alone. There's a lot of room for this company to grow. And I think just focusing on that market in particular will help the company and further improve their business.
All right, board needs to approve this, but it should be done by 2020, so it's a little ways out.
It's a little ways out, yeah, and just again, I mean, it seems to be really widely, I guess, received very well on the street. I was going through some of the analyst notes, talking to some people down on the floor just earlier today, just getting the reaction, and they were saying that this is long overdue. This is something that the company should have done years ago, and the fact that they're finally doing it makes it seem like they actually get what's going on, that they know what needs to happen, and it makes sense going forward for the future.
Well, a near 20% bump in the stock price at this moment as we're talking right now, so it does seem like the street is hailing this. Shauna, thanks for that.
Thanks.